Hey, it's Jim, and this is FRM Part 1, the topic on financial markets and products, and the chapter on exchanges and OTC markets. This is almost exclusively a definitional chapter, but like many of these chapters, to be successful in the exam, you're going to have to pay attention to the terminology and the application of that terminology to a good exam question or two, and then the context of the environment in which we're operating. Let me just start with another silly example. Let's suppose that you and I are next door neighbors and I knock on your door and I want to borrow $10. And you say, you know what, Jim, I'm not sure if I trust you. Why don't you put up some collateral? And I go, hey, here's a hammer, $11 hammer. So I put my hammer back in my garage and you hand me the $10. And let's suppose I agree to pay you back in a week. So how can we resolve the repayment of the loan? Well, I can walk over to your house in a week and hand you $11. Let's suppose it's 10%. Or you could come and walk on my front door and knock, and I could open it and hand you the $11. The problem is, what happens if I don't answer my door? What happens, in fact, that I hide and you can't find me? I guess you could break into my garage and take my hammer, collateral. We'll talk about collateral in a little bit. But you're probably very likely to just put a sign up in my front yard that says, Jim is a deadbeat. Don't talk to him. Let's ostracize him from all of the neighborhood fun activities. Now, the problem arises if you and I don't know each other. Let's suppose that you live on the North Pole with Santa Claus and I live in the South Pole with whoever lives down in the South Pole. And somehow in outer space, we meet and we make a directional bet. I think that the price of gold is going to fall. You think that the price of gold is going to rise. Well, after some time goes by, let's suppose that I'm wrong and I owe you that $11. Well, how can you track me down? You don't even know who I am, let alone where I live, let alone be able to put a sign up in my front yard or come into my garage and take my hammer, which, by the way, would rightfully be yours anyway. So these learning objectives are really just a description of how can we find each other if you live in one part of the earth and I live on the other part of the earth. So this is really in the context of a discussion on default risk, but we're going to call it counterparty risk. How can we reduce that? There's netting, there's margining, there's collateral, there's CCPs out there that we'll talk about at length. There are different kind of markets that operate out there. There's all sorts of fun stuff. And so the exam questions from my perspective here as a good test creator, I'm going to pick one of those that we just described and ask a good question. And then I might talk about collateralization. I think that's important. That becomes super important when we get to part 2. But then one of my favorite topics, and I would ask a question on a special purpose vehicle, although that's only, the very end of the chapter, which is just a handful of paragraphs. But after taking the part 1 exam, I got the sense that what GARP likes to do is that they like to emphasize stuff in part 1 that's going to be important in part 2. I mean, that's not true throughout the 100 questions that I sat through, but we'll see when I sit through the 80 questions in part 2 if I ever get that far in my life. Anyway, all right, let's go ahead and start here with, hey, before modern exchanges. So here we have, here's me and there's you, and we're shaking hands at your front door. So back in the old days, what would happen was that there was just kind of a forum, and we would just kind of get together and we would visit. And remember now, back in the old days, people pretty much knew each other, if not personally, like neighbors, but they knew each other by reputation. Nevertheless, there was still a lack of protection against this default risk. So what the text emphasizes is that this was bilateral exposure. That's an important term as we move through this slide deck. Bilateral was, you and me as neighbors. If I didn't pay you and I didn't put up my hammer for collateral, then you were at a full loss. And look down at the bottom. The exchanges, they could expel dishonest members. That's the putting the sign up in my front yard. So netting, let's go back to my example. Let's suppose that I'm looking out my window here in the front yard. Suppose I can see my 3 neighbor houses. Suppose I owe each one of them $11. And then I look out my backyard and I have nice Leland cypress trees back there. If I look through there, I can see my other 3 neighbors and they each owe me $11. Well, think about this. I mean, I could go and knock on their doors and collect, and then go over there and pay. But that's really doesn't do me a whole lot of good. It's a waste of time because I'm even Steven. Do you remember that Seinfeld episode where Jerry was always even? So what this netting process does is that we meet somewhere up above, we meet in the neighborhood somewhere, and somebody in charge says, hey, Jim, it looks like you're even Steven. You don't even need to leave your house. We'll let those people go ahead and pay each other. Now, when we meet on one of these exchanges, we're going to have to put up some kind of a margin. And so there's this thing called an initial margin. So let's suppose you're at the North Pole, I'm at the South Pole, and we agreed to trade, what did I say, price of gold. Well, each one of us is going to put up an initial margin. And let me just pick a number. Suppose it's $100. And what happens is that if one of us loses, then whoever's holding that margin, probably some kind of an exchange, they're going to say, hey, Jim, you lost $11. We need to send it to the North Pole. So the North Pole person has $111 in their account, and I only have $89 in my account. And once that initial margin, that's the first trading. And then we have a maintenance margin, which is always a little bit less than the initial margin. And then if the balance falls below that maintenance margin, then I'm going to have to make a deposit, and that's called a variation margin. And that occurs mostly with daily settlement. And I'm guessing that you guys, if you have not watched Trading Places with Eddie Murphy and Dan Aykroyd, that's a great movie to watch, not just for its comedy benefit, but for seeing how those orange juice futures contracts work, and that's daily settlement at the end of the movie. And of course, Eddie Murphy and Dan Aykroyd, they win hundreds of millions of dollars or whatever it is, enough to buy a boat and live on an island. Now, the other part of this, so here's the the fourth one. The other part of this is that me and then my neighbors and you're my next door neighbor and my neighbors back here, we all have to pay somebody. We call this a default fund contribution. So every time we make a trade, we may have to put 10 cents into that default fund so that if my neighbor over here, or let's just say it's me, I'm the deadbeat, right? So if I don't pay, then, well, I've contributed 10 cents here and 10 and 20. So maybe I have $11 in my default fund contribution. So then the person in charge just dips in and takes out that $11. All right, interestingly enough, we haven't gotten to one of these learning objectives, is that I feel like I've pretty much covered almost everything that's inside of this chapter, with the exception of some terminology. So let's focus on that. All right, we have this CCP, a central counterparty. And central counterparties, they go back to the exchanges. I'm not going to remember the year, maybe 1870. Remember, New York Stock Exchange has been around for 1,000 years. The currency exchange, they've been around for a long, long time. But so these things really became formalized, as we moved into the 1900s. So sometime back then, I don't even know how long ago that was if I don't get out my calculator. So there's somebody in charge. And what that somebody in charge does is that they have this legal right. Of course, they have lawyers in there. That, what did I say? I had 3 contracts with the neighbors over here, 3 over here. Well, this person in charge, this central counterparty, that organization, that clearinghouse will go ahead and write separate contracts. So I have a contract with my neighbor over here. What the clearinghouse will do is they'll write a contract with my neighbor and write a contract with me. This is the process called novation, and it's legal and it's enforceable. What that means is that, hey, I don't have to find you at the North Pole. You don't have to find me at the South Pole. All I have to do is find the clearinghouse, because that's with whom I have the contract. So we have a little graph over there, a little illustration. There's the clearinghouse in the purple, trader A and trader B. So think about that as like, what did I say earlier? Outer space. I don't really know what that means. Now, the way this works, and pretty much, and probably the only way that this could work, is that these clearinghouses say something like, well, you might be at the North Pole, you might be at the South Pole, but we're going to settle every day. This is called marking to market. So we get the market value of the underlying asset. Maybe it's gold, maybe it's an interest rate, maybe it's a mortgage-backed security. We look at that thing, whatever that market value is at the end of the day, and we say, oh, hey, Jim, you bet that it was going to go up, but it went down. You lose, so you owe us a bunch of money. And so we go back here. I did the initial margin, and then I have the maintenance margin. I may have to put up extra payment as the variation margin. So this happens every day. I want you to think about what this means. And this is so important as we, kind of sift through all of the risks that are out there for financial institutions. The fact that these over-the-counter markets, but especially the organized exchanges, have massive marking to market and massive daily settlement, that means they have massive liquidity. So you can get out of these things. You can go to the Chicago Mercantile Exchange and you can get in and out, long and short position of a futures contract, just like that. So what did I say earlier? I said we each had 100 in our initial margin, then you had 111 and I only had 89. So what you can do is you can take out that 11. You could probably take out even a little bit more than that, but then I have to start putting money in. So variation margin, look at that. Obligations are immediate. And at the end of the Trading Places movie, the dude from the exchange says to Mortimer and Randolph Duke, hey, all of our accounts are settled daily. You owe us $476 million. Oh my goodness gracious. Yeah, this is important here. This is a great exam question. Look at the bottom. Yeah, limited to one trading day's price movement. So if the price moves either in your favor or against you, you settle up at the end of the day, and then the next day is a rolling bet. So it's a different bet. You start all over. And so if I'm in here, and what did I do? I bet the price of gold, it goes down, so I lost $11. The next day, price of gold goes down, I lose $14. And then the next day it goes down, I lose $18. Well, I can quit. I don't have to wait until the end of the maturity date of that futures contract. And that's what makes these exchanges so attractive, is that, boy, tremendous amounts of liquidity. All right, I pretty much covered all this, the initial margin. So yeah, each party has to put it up short and long position, whatever it is. I can't imagine that GARP would ask you about the size of the margin, but if it does, just remember that if you are, let's suppose that we're on Jim's exchange and there's a futures contract on the price of our financial calculator. What do we know? Whether you use the HP or the Texas Instruments, the thing is pretty stable. What would the initial margin be? It would be this much, because there's no fluctuation. There's no variability, no volatility in the price of a financial calculator. Maybe it goes up a little and down a little over time, but compare that to the price of gold. Oh my goodness gracious. Gold is way up here in the mid 2020s. Is it 3,000 or 4,000 or 8,000? Every time I watch TV and or pick up my phone and they tell me about the price of gold, all I can think about is that great James Bond movie, Goldfinger. Yeah, I think I covered all that stuff there. I also made a comment that every time I made a trade with my neighbors, I had to put 10 cents into this default fund. So what happens is, this is what your chapter calls mutualized protection. Everybody puts into this defaulters fund, which means then that if I had $11 in my account, then the clearinghouse would dip into that and then pay you guys at the North Pole the $11. But if I have if my default fund is zero and I'm not answering my door, well, remember that the clearinghouse wrote a check with you up at the North Pole. So you're expecting to get your $11. You don't care about me. You don't care if I cut my grass. You don't care if I lent my neighbors money. You don't care. You want your $11. So all of my neighbors contributed to this mutualized default fund. So what the clearinghouse does is they take all of this money, right? And they, invest it. And so over time, they build up some equity. So if all of that goes to zero, then we can dip into the clearinghouse's, kind of a buffer. That's kind of the mass buffer. All right, netting, this is super easy. This is just the clearinghouse telling my three neighbors over here that they don't owe me $5 each. They owe my neighbors over across the street $5. And the important thing here to remember is that, if I'm a hedge fund and I have long and short positions in shares of stock, in mortgage-backed securities, in credit default swaps, futures contracts, I've got some options out there. That's a lot of stuff to keep track of. So what we're going to do is we're going to have this netting procedure. Somebody really smart is going to keep track of all my transactions, and they're just going to net them out. Yeah, notice at the bottom it says simplified settlements lowers systemic exposure. Remember that systemic, the system, the economic system, the financial system. We don't want my failure to spread. We call that contagion. We don't want that to spread to you at the North Pole and to people all over the world. Notice it also improves liquidity. So I have said that before. Keep that in mind when you're answering these questions on the exam. Let's see, governance and transparency. So let me change roles here. If I'm the clearinghouse, so what do I have to do? I got to keep track of all you people out there all over the world. And which means that I probably need to have some kind of a governance structure that says, hey, if Jim lends to these people over here and borrows from these people over here, I need a process to keep track of that. So strict governance, oversight to ensure reliability. Because, what can I do? At the end, when there's massive movement in prices of the underlying asset, I could just throw my hands up and say, you know what, I quit. I can't keep track of all this stuff. I have a migraine. So we need all this strict governance, and of course, need to review price volatility for margins. I need to make sure that I record all these trades and monitor. And you guys know this from just the little bit that we've done in part one, that GARP and the financial institutions, they're super big on stress testing. So the question then becomes, hey, suppose that we have all these long positions over here, and then we have all these short positions, but the long is this big and the short is this big. What happens if we have a stock market crash? What happens if we have a stock market surge? What happens if the mortgage-backed security market goes flat? What happens? So we need to conduct these regular stress tests. All right, netting, process of offsetting positions. We did all that. Single payment or settlement, bilateral. So this is just you and me as neighbors. Two counterparties would offset, but then the clearinghouse is probably going to keep track of all of that. And that's what I was saying, that these people over here owe the $5 or the $11, whatever it is, to those people over there. Now, in the over-the-counter market, now this is really important, and I have emphasized this in previous slides, but let me go ahead and repeat myself. Remember, on organized exchanges, you pretty much have standardized contracts, standardized in terms of the amount, and then standardized in terms of the timing. Over in the OTC market, there's standardization there as well, but there is great room for what the chapter calls customization. I always use the word tailored, because if I want to sell a derivative security based on my house here, my location, my house, I'm going to make up an address, 100 South Pine Street, and let's just put a value on it, $200,000. Well, I can create that derivative security, but there's probably not a huge secondary market for 100 South Pine strategy. So the netting of those over-the-counter trades is probably a little bit more complex in terms of there's more bilateralization. I don't even know if that's a word, and less centralization. That's probably a good exam question. Here's another good exam question, but you know this, right? Reduce settlement volume, right? I don't have to do anything. Reduce default risk. We'll call it counterparty risk. But I like this third one here, capital efficiency. Instead of me having to go get the money from my neighbors over here and pay over here, well, what I can do is I can invest and I can earn a rate of return because I'm losing time and money as I walk over there, and the same thing as I do over here. So that's a good benefit. Margining, I think I've explained this already, so look down there. Yeah, we post an initial margin, and so that acts as a buffer. It can be collateral. And by the way, most of the exchanges, I mean, particularly the organized exchanges, they allow you to use other stuff. I mean, it's not like you got to run down there and hand them a whole bunch of $100 bills. If you have treasury securities, especially treasury bills, you can just say, hey, here are my treasury bills. Let's use that as the initial margin. Now, of course, if you lose and you have to pay a variation margin, then it gets a little more complex if you tell the clearinghouse that, hey, go ahead and sell my treasuries. They're probably going to say, you know what, Jim, why don't you come and put $11 in the account? It's easier for all of us. Yeah, so if I lose, then I have to put up this additional margin that's called the variation margin, determination, market value, volatility. I said all that stuff before. Determination of margin requirements. I think I said this. I'm pretty sure I said this. This doesn't sound like a really good exam question. What did I say to you before? That was the calculator volatility versus gold. So just think about that volatility in addition to the volume of that risk position, the liquidity of the asset. I mean, if it's a treasury bill, then, that's super liquid. We probably don't need to worry about it. But if it's my hammer in my garage, well, there's probably no liquidity. And remember, each organized exchange and even the over-the-counter market, they have their own kind of sets of rules. Years ago, my buddy, who was another college professor, and we went to Chicago, and we spent the day at the Chicago Board of Trade. This was 20-some years ago. And the next day, we went to the Chicago Mercantile Exchange. And those of you who are living in Chicago or working there, you'll know this to be true, that we spent the day listening to the people at the CBOT. They didn't like the people at the Chicago Mercantile, so they had their own rules. Then we went to the Chicago Mercantile Exchange, and we told them we were over there, and they were saying, we don't like those people over there. Of course, it's interesting now that they're all one entity. I did say at the beginning that this was almost exclusively a definitional chapter, where here's where you might have to get your calculator out, but I can't imagine that GARP would ask you such a simple question here. Let's do a call option here. Option premium is 2% of the $47 of the stock price. Look at that second teardrop. So these numbers could be almost anything. 100% of the option price plus 10% of the stock price. So go ahead and compute the initial margin, $5.64. Hey, if GARP wants to ask you this question, man, go ahead and answer it, and then mark that up as at least one that you get right out of the 100, and move on with your life. All right, here's one of these potential exam questions that we like to give. So there's this thing called a waterfall. You might remember this from, other kinds of securities, other derivatives, other hedge funds, other payment structures that are out there with tranches, et cetera, et cetera. We have this waterfall. So where do you go? And, what is kind of the order? So I want you to look at those things and look at it. And remember, kind of the explanation that I've given you so far during this slide deck. Once we have this initial margin, okay, then what happens? Well, remember that we have the variation margin. So if the initial margin falls below the maintenance margin, I've got to put something in. Then I can go to my fund, my defaulters fund. Then I can go to the non-defaulters, all my neighbors, and then we can go to the equity. Now, the interesting thing is that each exchange, could have its own set of rules, and then netting somewhere falls in there at the towards the beginning of this. We're going to net. So if I owe this person over here, I'm not going to default over here because this person over here owes me a bunch of money. So instead of owing, this person $11 and I'm owed, let's say $4. Well, then, the exposure is just $7. So that netting does something in there. So my advice is, this is a good exam question, a good potential question, is just kind of remember exactly the order flow of how can you living at the North Pole recover the losses that you incurred with me living at the South Pole. I love having conversations with my students about buying stocks on margin. And, I always have some students who buy stocks. Now with their phones, they can do it, without even thinking. And I tell them, hey, you can buy a stock on margin, but I'm guessing that if you did it as a 20-year-old college student with no assets, that they might ask you to pay either a 25% interest rate, or maybe they'll lend you $2 out of $100. But in general, when you buy stocks on margin, these investment banking firms and the clearinghouse, they're going to make you put up 50%, sometimes 30%, 70%. It really depends on your reputation and your amount of assets. Let me give you a history lesson. In 1929, you could buy $100 worth of stock for just $5 in cash. The New York Stock Exchange would lend you 95%. So you have to say to yourself, duh, no wonder we had a stock market crash. All right, so what happens if you want to borrow, what was those numbers back there? If you want to buy $10,000 worth of stock, you may need to put up $5,000, maybe $6,000, maybe $4,000, maybe $9,999 if you're one of my students. So what happens then is that of course, whoever's lending you the money, they're going to charge you an interest rate. So this is a great exam question. We don't cover it here. What's the return on a margin account? So you need to consider the cost of the loan. But the emphasis here in this chapter is, suppose we borrow $5,000 and we invest $5,000 of our own. So we have a $10,000 investment in a stock. What happens if the value of that investment goes to 9,000 and 8 and 7 and 6 and 5 and 4 and 3 and 2 and 1? Well, sooner or later, the organization that lent you money is going to pick up the phone and say, hey, Jim, you owe us something. Why don't we work through just a quick example? So look down at the bottom, 50% margin. So there's 50% a loan, 50% of our own cash. The maintenance margin on one of these things is usually around a third. I always tell my students it's a third, but this textbook says 25 to 30%. So if you want to remember those numbers, that's probably reasonable. But if you're asked to compute the maintenance margin, GARP has to give you, they have to give you that percent. They'll probably give you an even percentage, like 25%. So all you have to do is divide by 4. And then when are you going to get a margin call? So here's just a good example. Stock price drops to 70. So we borrowed 5. So the equity that we have is now 2. Used to be 5, but now it's only 2. And if the maintenance margin, well, what did we say back here? 25 to 30%. If it's 30%, just take 30%, and you get the 2,400. So it's below that. So you got to put in $400. You guys should know that I regularly ask you to take pictures. This is a great time to get out your cameras. Go ahead and take a picture of this one. And take a picture of this one. Boy, there's probably 10 or 12 really good definitional type exam questions that GARP could ask you, especially in the context of all the stuff that we've talked about up to this point. So take a picture here. Notice there's some risks here. Let's go ahead and look at a little bit more detail, some of these risks. So that counterparty risk, that's just regular old default risk. Liquidity risk, so remember now, and there it is, it's written for you guys to know. The over-the-counter contracts, there's some standardization, but they can be customized. They can be extremely customized. I'm not sure if you want to put those two words together, but notice less standardized. Yeah, harder to trade. Positions may be held to maturity more so than over on the organized exchanges. And then operational risks. I'll just tell a quick story. When we were at the Chicago Mercantile Exchange, we were in the futures trading pit. And we were standing outside of it. These traders, they're writing all their hand signals and all, and then they're writing the trades down. And these are thick cardboard here, and they kind of frisbee them down to a dude who has a big old net, and he's keeping track of all this stuff down there. Well, of course, that dude, it was a guy at that time, but it could be anybody really. He could make any kind of mistake. That's operational risk. Those of you who are paying attention to anything in the mid-2020s, you'll recall there was a company called Tricolor out there, some kind of an automobile, accounts receivable, parts transfer, some kind of a firm out there. And they were placing collateral on their asset-backed securities to multiple investors out there. So if you have collateral, my one hammer, that only went to my one neighbor since I only had one hammer. Of course, if you remember the Enron case, they were putting leases as collateral, which they didn't even own. And then systemic risk, I talked about that just a few minutes ago. Here's another good slide that you can take a picture on in this. Now remember, so in the OTC market, we've got this ability to customize. So that's a great benefit. However, it comes with some marginal cost because you can customize. You're going to lack that liquidity. So how do we handle it? Well, the central clearing through those CCPs is pretty much the same thing, but they contribute to a default fund. It's just not on an organized exchanges. They still have daily settlement. They still have collateralization, although collateralization is much more common in the OTC market. The netting agreements, there's way more bilateral netting in the OTC market than there is on the organized exchanges. And then there's some regulation and transparency. All right, so there we go. Bilateral contracts. So there's a better role for collateralization. There's this thing out there called a credit support annex, which is like a central clearinghouse. However, what it does is instead of worrying about daily settlement, it worries about collecting the collateral and making sure the collateral has value. Like if I put a treasury bill as my collateral, well, that's pretty easy. If I put my hammer, I don't even know what they would do. I think the CSA would say, Jim, you can't use a hammer. But suppose that I put up the Pink Panther diamond. Oh, I sure hope you guys watch those old Peter Sellers movies. Even the new Steve Martin movie ones are pretty funny. But if I put up the Pink Panther diamond as collateral, well, you're going to have to call in a diamond expert to make sure that it's the exact Pink Panther. Now, he or she would have to get out his little lens and look in there and see can you see a little Pink Panther in there. That would be the support that it is accurate. Yeah, collateral, what does it do? Yeah, less credit exposure. That makes sense. So here we go. There's another good slide. Whoops, I did two of them. So take a picture of this slide. Great exam question. GARP loves to ask questions about similarities and differences. So they'll say something like, hey, here's a client and this client does this or this and this. Is it likely that? And so answer A will be, hey, this is an OTC market and there's a initial margin. And then B will be, hey, this is an organized exchange and something else. And C and D, something else. So get to know all of these, what are those, 6 rows? Yeah, 3 there and 3 there. So that you can answer, again, it's potential 10 or 12 questions in those 2 slides. Here's a really good practice exam question that we came up with. You guys know about the South Sea Company, the British government. This is a long, long time ago, over 200 years ago. The British government. Now, I don't think they owed as much as the U.S. federal government does, approaching $40 trillion. But the British government owned a bunch of money, and they couldn't pay it, so they made an agreement with the South Sea Company. So they traded their debt in for equity, and they gave the South Sea Company a monopoly to trade in the South Sea. I guess that's what it was called, to trade in South America. And so people, they're saying, oh my gosh, this is the greatest deal in the world. We want to buy shares. We want ownership. We want ownership. And so prices spiked. And yeah, of course, when you have a bubble, and this might be one of the first financial bubbles that was the result of massive trading. I mean, there are bubbles that go way, way back to the old time days with olive presses. I can't remember when the tulip bulb mania was, but I think it was a little bit after this one here, maybe 1770. Anyway, so the question is, hey, what of these modern exchange features could have changed this episode? And I'm going to go ahead and say, you know what? When people have lost their minds and it's anarchy on the floor of the exchange, I'm not sure that anything can stop them. However, the question doesn't say, okay, what do you do when people have lost their minds? The question is, what are some good tools there? So if you look through these, forward contracts, I mean, that's a good idea, but that's not going to stop the bubble from occurring. Netting, I mean, that's okay. But if you remember this, back in those days, 200 years ago, it's not like anybody had short positions, so everyone had the long position. So, I mean, that's fine, but it probably didn't work back then. And then higher default fund contributions, Part D. I mean, yeah, that's a good thing. So A and B and D, these are all acceptable answers. But because of the 200 years ago, when we didn't have all of this cool stuff that we have now, these things probably wouldn't have helped a whole lot. But if we have done the counterparty credit risk management, those 15 slides that we just covered, then all of this would have been lessened. We still would have had a lot of people losing money just because people bought Enron stock when they shouldn't have bought Enron stock. People bought Petco.com stock when they shouldn't have done it. All right, let's finish up here quickly. Let me give you just a quick example, and I want you to remember this because we do lots and lots more of special purpose vehicles in book 4, but also in part 2. So I want you to think about this: a special purpose vehicle. It's a legal separate entity. So here I am. I'm Jim. I have my house, and in my garage I have a beautiful John Deere lawnmower, and I have to cut my grass, let's say once a week. And let's suppose I paid $3,000 for that thing. But I would like to get my money back. So what I can do is I can put a tent out in my front yard. And I'm going to put my asset, I'm going to put my lawnmower in the tent. And what I'm going to do is I'm going to create this special purpose vehicle. It's called Jim's Tent. And I'm going to issue a bond. And they're going to be investors from all over the world, and they're going to buy into my special purpose vehicle. Now, remember, it's a league separate entity out there. So let's suppose, and this is really the cool thing about special purpose vehicles, is that I might be able to issue a bond for $3,500. I only paid $3,000 for that, but I might be able to get $3,500. Now, my bondholders who bought my bonds, that bought that SPV bonds, they're going to expect to get their interest payments. So I'm going to put a sign out on my tent. I'm going to say, hey, any of my neighbors, if you want to borrow this beautiful John Deere tractor to cut your grass, just put $40 into the hat out here. So my neighbors come, they put their $40 in, and they put their $40, and I take the $40 and I pay the bondholders. I have my money, the bondholders have their money. I can still cut my grass once a week if I have to, and my neighbors can cut their grass. There you go. There's Jim's silly but pretty good analogy of what a special purpose vehicle is. Now, of course, I'm not putting a physical asset in there, I'm going to go ahead and put maybe some mortgage-backed securities in there or some accounts receivables in there. And investors are going to buy into that so that they get exposure to a market that was unavailable to them. What this does, and this is important, look at the bottom there. What it does is it separates my risk from the special purpose vehicle's risk. Look, if the parent defaults, if I don't pay my mortgage and I lose my house, well, the tent stays out there with my John Deere tractor in there, giving investors greater confidence. Yeah, so my tractor is my collateral, just like my mortgage-backed securities. Now, what has to happen is that these ratings agencies, they're going to come along and they're going to evaluate. They're going to say, oh, Jim is right. This is a beautiful tractor. Cut your grass like this, smooth ride, doesn't give you a headache, et cetera, et cetera. But if I had a 50-year-old mower that my dad used to use when he first got married, that thing hardly ever worked. Well, the ratings agency is going to say, this is a C-rated lawn mower. And of course, this is what Moody's and Standard & Poor's should have done with those mortgage-backed securities at the 2008 financial crisis. But they didn't. They say, hey, Jim, it's a great lawnmower. And we bid up the price, and the rest is history. Oh, remember now, I've said this to you before, that GARP is going to ask you. There's a whole chapter on that financial crisis. And GARP does, I can tell you from taking the exam, they like to ask historical events, which I think is a great thing. Let's see. SPVs are used to issue securities. Okay, so what I do is I instead of putting something in the tent out there, I say, I'm going to put something in the tent. When you guys lend me money, I'm going to go out and buy gold, or I'm going to go out and buy something else. Yeah, advantage, markets efficiency, bankruptcy protection, widens the pools of investors. All right, so that was fun for me. I love talking about all of this really cool stuff. I hope my silly examples have helped you visualize the process of handling this default risk. So I usually tell you guys to go look at the questions at the end of the chapter, and I'm going to do that now. But these things are so simple. You should be able to skim through those in about 5 or 7 minutes. So, hey, thanks for watching. As always, have a great day and good luck studying.